Gold has been skyrocketing lately. In fact, it's been hitting all-time highs.
Gold is having a moment.
Gold is one of the star performers this year, up 13% to an historic high, outperforming stocks and bonds.
There are a lot of different theories as to why the price of gold is going parabolic, and most of them are wrong. I'm going to explain the real reason gold has been going up in 3 simple, fast steps. Step number 1, let's go over the argument for reflation. In fact, prior to that, let's go over a gold chart going all the way back to May of last year. We go from $1,900 up to $2,300. And in case you've been hiding under a rock over the last year, let me show you exactly what the gold price has done. It was going down, it really dipped down in October, then started to go up a little bit. Then once we get into February, March or so, it starts to really go up to about 2,200. It flatlines briefly before it just rips all the way up to where it is today, right around $2,400 per ounce. So in order to understand the real reason gold is going up, which is extremely important to try to predict whether or not gold will continue its path higher over the rest of 2024, you've got to look at the prices of other commodities and other assets. Let's start with a chart of copper. That's been going up as well. Oil was right around 70, low 70s or so, and now it's mid 80s. And then let's not forget about some macroeconomic metrics such as the CPI. The last reading that we had surprised the market to the upside, and some were saying that this CPI print was quote unquote hot. And when you combine this with what we see going on with commodity prices, we could come to the conclusion that we're heading in to a reflationary cycle. In other words, we saw inflation as measured by the CPI up around 9.1% in June, July of 2022, but then we have had disinflation since then. But if you look at the 1940s, if you look at the 1970s, 2 of the last decades of inflation in the United States, we see that inflation doesn't go straight up. It goes up, it goes down, and it comes back up again. So the theory is when you take all of these data, you come to the conclusion that we have entered the next wave of inflation. In other words, we've entered a cycle of reflation. Whoa, time out. Let's go ahead and pump the brakes a little bit on the reflation and go back to 2022 when we saw inflation going up and up and up until it peaked, like we said, at 9.1%. As most of you know, the government most likely understates the real rate of increases we saw in consumer prices. So back during this time of significant consumer price inflation, what was gold doing? Was it doing the exact same thing that we see today? No. It was actually flatlining. I'd been going up or down slightly, but it definitely wasn't going straight up. So when we look at that specific time frame, there definitely was not a correlation between the CPI or inflation and the price of gold.
Step number 2. Now let's go ahead and look at this reflation narrative driving the price of gold higher through the lens of the monetary system. Okay, let's go straight over to a chart of the dollar, or the DXY, just using that as a proxy for the dollar relative to other fiat currencies. And we can see that during the time gold has gone up recently, the dollar has gone straight up as well, to the point where currently we're right around 106. Now, to give you some context, let's zoom out a little bit and look at a chart of the dollar DXY going all the way back to 1980. We can see that with the exception of 2022, we are close to an all-time high going all the way back to the early 2000s. In other words, we're close to the highest levels the dollar has been in the last 20 years. And the pushback I would receive is, well, George, I get what you're saying about the dollar, but we all know the dollar, or what the dollar is doing relative to other fiat currencies, is simply a result of interest rate differentials. And since the marketplace believes that the Fed is going to stay higher for longer due to the CPI print coming in hot, let's say, or due to commodity prices, then this explains why the dollar has gone up while gold has gone up at the same time. But then we have to step back and say, okay, well, if this is true, that the marketplace is predicting that the Fed is going to stay higher for longer, or maybe even have to increase rates going into 2025, then why would gold go up as well? Because usually the argument for gold, or one of the arguments for gold increasing in price, is negative real interest rates. Well, if there's a greater probability the Fed is going to increase rates, then there's a greater probability that the real interest rate is going to increase. And this should be negative for the price of gold. So the action that we're seeing in the dollar and in gold really doesn't make sense at all until you look at it through the lens of bank credit. Let's look at a chart of bank credit going all the way back to 1973. Good year. That's when I was born, in fact. So we can see that you've got a very distinct trend, or you usually do. But we have times such as the early 1990s, the dot-com bust, and the GFC, where bank credit flatlines, or in the case of the GFC, actually goes down. It's far below trend. And these are times when the US economy is in recession. In other words, disinflationary pressures are prevailing, the furthest thing from re-inflation. In fact, I'd like to point out there was a quarter in 2009 where we actually had deflation. That's literally the opposite of inflation, or in this case, a reflationary cycle. So bank credit was going down and consumer prices went down as well. So if we fast forward to the last year or so, we can see this dynamic in bank credit that we saw during the GFC playing out right now in real time. So you have to ask yourself, how is it that we can go into the next wave of inflation if bank credit is flatlining, if not declining, based on its prior peak? Now, I know a lot of you right about now are saying, okay, George, I don't really understand the connections between the banks and how many currency units are circulating, chasing goods and services, or how what the banks are doing may impact the price of what I buy every single day at Walmart, Target, and Home Depot. Okay, let's go over to a chart of M2 money supply. And this is by no means perfect, but it starts to give us an idea of what's happening with the amount of currency units that are out there chasing goods and services that you would think would need to increase in order to have consumer prices continue to go up over a sustained period of time. M2 money supply has gone down significantly since 2022. And more specifically, if we look at the M1 metric of money supply, this gives us a better idea of what's happening with the checking account balances and the savings account balances of the average Joe and Jane, the non-bank entities in the real economy. And look at this. First of all, you've got to ignore this just straight up move in 2020 because they actually changed the way they measure M1, and they took a component of M2 and moved it into M1. And of course, M1 is a component of M2. So this huge spike up doesn't really tell us anything. So we really need to pay most attention to what happens after May of 2020. And it goes straight up like M2 till we get to 2022. But since then, it's not just flatlined or slightly gone down, it has plummeted. from 20 trillion all the way down to where we are today at around 18 trillion, which sounds like a lot until you think about the fact that's a decrease of $2 trillion. Before we move on, let's go ahead and give you some more context around these money supply metrics and go back to the 1970s when we absolutely did have an entire decade of inflation, although it didn't go up in a straight line. So if we zoom in on this M1 money supply chart in the 1970s, we can see that it went straight up. It didn't buck the trend until we got to 1980. Now let's look at a chart of M2 during the same exact time frame, the 1970s. But we're going to go over to longtermtrends.net. The reason I want to look at this is because it gives us a compounded percentage increase for the overall decade in this metric of the overall money supply. And it's represented by this black line. So over the span of the 1970s, it went up by over 150%. Again, compare that to what we've seen over the past year or two when it's actually declined. So the main takeaway from step number 2 is when you look at the dollar, when you look at what's happening in the banking system, and then when you look at what's happening with the domestic money supply and compare that to what we saw in the 1970s, it's very difficult to come to the conclusion the United States economy, or the global economy for that matter, is heading into a cycle of reflation. And therefore, that's why the gold price is going up. The move in the gold price, or the real reason for the gold price going up, most likely is something entirely different.
Step number 3. Now let's go ahead and try to answer the question, what is the real reason gold has been skyrocketing? To be clear, there are no certainties, there are only probabilities. So what I'm going to do right now is give you my base case based on all the research that I did for this video. But at the end of the day, you've got to come to your own conclusions based on the probabilities. Okay, let's look at a chart going all the way back to 1970. This again is a gold chart, but it's quite a bit different than the one we saw in step number 1. Why? Because this is a log chart. So this allows us to better see the percentage moves in the price of the barbarous relic, the yellow metal. As you would imagine, in the 1970s, it goes straight up over 100. And then when we get the bear market in stocks of 73, 74, it goes down pretty substantially. But again, nothing goes up in a straight line. And then at the end of 1980, 81, it was at its high, I think in nominal terms, a little over $800 per ounce. But then it just really goes straight down till we get to a point right around 2000, 2001, where it goes up and up and up and up, and it doesn't stop until we get to about 2011, 2012, and as you would expect, it starts to go down again until we get this most recent move where we have hit all-time highs in nominal terms. But prior to doing the research for this video, I've got to be honest with you. I assumed the reason gold was going up so substantially in price was geopolitical risk. We all know what's going on right now with Russia, Ukraine, in the Middle East, and more recently with Iran launching missiles, or a missile attack, a drone attack, on Israel. Now we're just in a holding pattern, waiting to see what Israel is going to do, how they're going to respond, and is this going to escalate? The bottom line is we're a lot closer now to World War III than we were a couple years ago. Nobody would dispute that. So is the answer increasing geopolitical risk? Let's go back in time to the early 1990s. I'm sure a lot of you remember the Gulf War. We didn't really see gold spike that much. And we fast forward to 9/11, and gold might have gone up a bit, but nothing like it's gone up recently. And I would argue the trend in the price started prior to 2001. Well, let's go ahead and look at inflation, because we see the 1970s, the price really went up. That's for sure. There's no disputing that. And the takeaway most people have from the 1970s is gold was a hedge against inflation. Okay, well, this would lead you to the conclusion that the CPI must have gone parabolic in this move with the gold price. And if we look at what the CPI was right around 2000, we fast forward to when gold started to decline, say in 2011, 2012, we see the CPI was pretty much flat. It didn't move at all. And a lot of people would argue there's an inverse correlation with the dollar, but as we discussed in step number 2, the dollar has gone up since 2019. So this doesn't explain it either. But there is one thing that does. Editor, let's go ahead and throw up a chart of long-term super cycles with commodities. And what we can see is the uptrend in the last super cycle really got moving in the 1970s. And then it crashed in 1980, 1981. It kept going down until right around 2000. And then when did the commodity supercycle hit its peak? Well, right around 2011, 2012 with the price of gold. So in my view, what the yellow metal, the barbarous relic, if you will, that I think everybody should own is telling us right now is it's confirming that we are definitely in a long-term commodity supercycle, and these uptrends in the cycle usually last 10 to 15 years. And let's rewind going all the way back to 2020, and this would make sense. If we're using oil as a proxy for commodity prices, let's not forget oil went negative in 2020, negative $38 a barrel. So I think it's safe to say that was a bottom in the oil price, and likely that was a bottom in the last downtrend in the supercycle, and now we're, let's say, 4 years into the uptrend. Now, to be clear, these commodity prices, like everything else, don't go up in a straight line, but they usually trend higher and higher and higher over the span of over a decade. So my base case is gold, although it's moving at a much faster rate, is trending right along with commodity prices, and we're not going to see the absolute peak until after 2030. But keep in mind, the conditions that create the supercycle to begin with also create massive amounts of volatility in the prices. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.